Welcome to Stock Trader School, from rookie to Rainmaker, and this is Wall Street Walkthrough, where we explore the mechanics behind the markets. In this episode, we simplify high-frequency trading, what it is, how it works, and the impact it has on your trades as a retail investor. The New York Stock Exchange handles about 10 billion shares every day. If we're just doing some basic division, that works out to about 10 million trades. But that number is off by a few zeros. In fact, the NYSE handles around 1 trillion trades every day. A single firm might make 1 million of those trades in a day. So if you're curious about who these firms are and how they make so much money from the stock market every day, keep watching, because today we explain what high-frequency trading is and why it happens. And welcome again to the channel. Let's start by answering the most basic. What is high-frequency trading? The term refers to trading strategies that place thousands, millions, or even billions of buy and sell orders per second. And while the name implies a certain level of sophistication, the reality is that high-frequency trading is often just an automated way of generating income in the financial markets. It's really nothing more than program trading on steroids. Instead of relying on intuition, these programs rely on complex mathematical formulas, known as algo or algorithms, to generate profits in the markets. It sounds complicated because it is, but here's the basic premise. The algorithm will scan order books at lightning speeds, identifying mispriced assets before executing trades to take advantage of the difference. If an asset is 1% undervalued, the algorithm will automatically purchase the asset with the expectation that the price will correct upwards over time. Same goes for shorting, except in that case the algorithm would wait for the asset to become overvalued before selling it. But algorithmic trading isn't new. We first saw its rise in the 1980s with the advent of the Black-Scholes model. The model allowed traders to calculate fair value on options based on a range of factors, including the current price of the underlying asset, volatility, and time until expiration. That sparked the idea of creating algorithms that could trade options automatically based on predefined rules. Pretty soon market makers were using them to set bid-ask spreads on options and stocks. Then arbitrageurs started using them to exploit price differences between different markets. It was only a matter of time before individual investors followed suit. But unlike their market maker counterparts, retail's goals don't align with HFT. Sure, we all want to make a profit, but oftentimes HFT strategies result in losses. For example, in 2009, a group of researchers from the University of Chicago found that the average equity return for HFT was negative 0.4%, meaning that in aggregate, HFT strategies lost money during the study period. And that was after accounting for transaction costs. Other studies have found similar results. Between 2005 and 2010, the average annual return for HFT was estimated to be somewhere between negative 0.5% and positive 0.3%. It's hard to say exactly because the data is pretty opaque, but one thing is clear: most HFT strategies are barely profitable, which raises the question, if HFT strategies aren't particularly lucrative, then why do they exist? Broadly speaking, there are 4 reasons why companies engage in high-frequency trading. The first reason is market making. Remember when we said that market makers use algorithms to set bid-ask spreads on options and stocks? Well, they also use them to execute trades once an order is placed. The algorithm will match the order with the best available counterparty. When you think of a market maker, you probably think of Citadel or Virtu, but the truth is that all major brokerages are market makers too. They just don't disclose it. And since retail brokers receive priority on their own order flow, it makes sense for them to route those orders to market makers like Citadel and Virtu. In fact, every single retail brokerage does it, even the ones that claim not to like Robinhood. Second reason is arbitrage. Arbitrageurs use algorithms to identify price discrepancies for the same asset across different exchanges. For example, if Microsoft is trading at $270 on the Nasdaq and $270.01 on the New York Stock Exchange, an arbitrageur would buy the stock on the Nasdaq and simultaneously sell it on the NYSE, locking in a risk-free profit of 1 cent. Obviously, these days the profit margins for arbitrage are extremely thin, which is why many firms have turned to high-frequency arbitrage instead. Unlike traditional arbitrage, which involves holding a position for more than a day, high-frequency arbitrage involves closing out both sides of the position within a day. Third reason is liquidity provision. Most people don't know this, but market makers actually post two types of orders into the order book. The first is a limit order, which simply sits in the order book waiting to be matched with a counterparty. The second is a market order, which gets executed immediately at the current market price. Market orders provide liquidity to the market, which is why they're sometimes referred to as liquidity-providing trades. These orders are typically very small, but because they get executed immediately, they help facilitate transactions between buyers and sellers. Liquidity providers often receive a small fee for providing liquidity, which helps to offset the cost of execution. And finally, there's the less savory fourth reason: front-running. Front-running occurs when a broker executes their own orders ahead of their clients, taking advantage of inside information. For example, let's say a broker knows that a large buy order is coming for Apple. In this scenario, the broker could front-run the order by buying Apple stock ahead of the client, ensuring that their own orders are executed first. Obviously, front-running is illegal, but the lines between legal and illegal are blurry at best. There are many ways to get away with it, and when you're talking about billions of trades a day, well, you do the math. So we know how it works and we know why it exists, but how exactly does HFT affect us? Some of the effects are obvious and some are subtle. Take slippage, for example. Slippage occurs when an order is executed at a price worse than the one the trader expected. It happens because the market is constantly changing and the price of an asset can move significantly in just a few seconds. This can be problematic for high-volume traders who may not be able to absorb large amounts of slippage. As it turns out, HFT exacerbates slippage. By placing a large number of orders at almost the same time, these firms increase the likelihood that prices will move against them, resulting in higher levels of slippage. Then there's fake liquidity. You've probably heard of liquidity pools before. They're used in cryptocurrency trading to allow for the execution of trades without a central counterparty. But liquidity pools aren't exclusive to crypto. In fact, they're used throughout the financial system. Liquidity pools are made up of a collection of limit orders from multiple market participants, and HFT exacerbates this problem by adding liquidity to the pool with the sole purpose of taking advantage of other traders. For example, let's say you place a limit order to buy a stock at a certain price. A high-frequency trader might see this and add a fake liquidity in order to trigger your order. Once your order is executed, the high-frequency trader will remove their fake liquidity and either execute their own order at the current market price or cancel it altogether. Either way, they win. Then there's sudden spikes. Have you ever been in the middle of an intraday trade only to have your charts go haywire? Well, those sudden spikes in price might be caused by an HFT glitch. Because these firms place such a high volume of orders, they're more susceptible to errors than the average trader. When this happens, they may inadvertently place a large number of orders at an unfavorable price, leading to a sudden spike in price. Ultimately, these are just a few ways that HFT affects us. There are many others, but we'll leave those for another video. The main takeaway is that high-frequency trading isn't always what it seems. Sure, these firms provide liquidity to the markets and make it easier for traders to execute their trades. But they also exacerbate slippage, create fake liquidity, and occasionally cause sudden spikes in price. We're not gonna lie, most of this stuff is common sense, but trust us, you'll want to have it handy next time you trade. Thanks for watching and remember to subscribe and hit the bell.